HIMS is a healthcare company, probably resembling also a consumer discretionary or a consumer staple company. They provide a variety of products that help people take care of themselves, whether they want to grow a little hair, take care of their skin, do a little weight loss, or really amp things up in the bedroom. And they have these categories of products that are pretty popular these days, especially the weight loss category that's been very profitable to Eli Lilly. Now, I wanted to take a look at the company and go through an evaluation from an investor standpoint. The stock has really flourished, but more recently really came down in price. Even though they had earnings that were really impressive, the stock still went down. So let's take a look and see how the company's doing. Let's take a look at the earnings report and look at fundamentals. Also, do a valuation based on free cash flow. Also, look at an evaluation based on earnings per share. I'll take a look at see what analysts are saying about the company, and then form a conclusion. Would I buy this stock? Would I sell it? And then close this video out. HIMS reported really impressive earnings. When you look at their revenue growth, year over year growth of 69% is impressive. And they're doing it while being profitable and generating free cash flow. The four general categories of products that they sell are sexual health, dermatology, weight loss, and mental health. These products have been around for a long time. Probably weight loss has really become popular because Eli Lilly and other pharmaceutical companies have come out with drugs that have been proven to help diabetics, and a lot of people lose weight. So it's become an exciting category. But the categories that HIMS operates in have been around for a long time. And one reality is that they have plenty of competition in each market. I read through the priorities that they have for longer term growth and longer term value creation for the company. I think they're good ideas. Overall, they want to continue to be a player in the weight loss specialty category for good reason. That's just a category that's been around for a long time and will be around for a long time because people want to control their weight. They're also going to build capacity in the lab and so forth. The impression I get is they continue to get bigger and begin to somewhat resemble a pharmaceutical company, which is good and bad. Good news is they're going to have the ability to create more products, formulate more products. The bad news is pharmaceutical companies, they've been around for a while, and it really does take a lot of expense up front to really build the scale that you need to be a very profitable pharmaceutical company. And I think the aim towards being a more legitimate player in healthcare is going to take a lot of investing. So it's not going to be easy for the company. It's going to need to deploy a lot of capital to get to that outcome they're looking for in this area. The company provided guidance on how they're going to perform in 2025, and it looks good overall. Very good growth. Profitability is not going to grow and expand as fast as revenue growth. The company does spend a lot on marketing, which is a big cost category for them. So the expansion of EBITDA margins, net margins, is a little bit concerning. I think that was the second reason that the stock sold off and continued to sell off is the company is shrinking their margins. And what's been interesting about HIMS is usually small businesses that are in healthcare are not quite as profitable at the beginning as they are over time. And the reason for that is scale. As you get bigger as a pharmaceutical company, as an example, you build the factory once, and whether you create 1,000 units or 10 million units, it's one factory. So your efficiency goes up and your profitability goes up. And to see HIMS go the other way, which is at the beginning they were more profitable and their profits are shrinking, that goes to show that they don't have scale advantages potentially. They're more of a marketing company than they are truly a healthcare product developer and producer. The company operates in a consumer economy, and they really want to grow a platform of subscribers so that they can have customers stick with them for a while. Understandably, they would love to have customers continue to buy product, and especially at high margins. You think about the marketing cost that the company invests in getting customers, you really are paying a high amount to acquire a new customer. You want them to stick around with you so you can be profitable in that relationship. It's totally a good idea. Just the reality is that in consumer economies, customers can go away rather quickly. What is the moat that would keep customers coming back? The categories that HIMS operates in, they have competition in each category. It's not like they're the only weight loss drug out there. In fact, there's many, and there's been weight loss programs for 50 years, and there'll be weight loss programs for another 50 years that are not pharmaceutical based. And now we have pharmaceutical based weight loss drugs that are legitimately prescribed and legitimately provided to customers using their health insurance. So that's just a reality of their business is, as mentioned at the beginning of the video, they're a healthcare company, but they also have attributes that make me believe that they're a consumer discretionary, consumer staple company because they have to compete to keep their customers. They have to compete to get new customers, and they have to compete ongoing with established players as well as new players that are entering the market. In the fourth quarter, net income went down, which was a bit of bad news for investors. And in addition to the net income going down, the cash flow also went down. If you look at free cash flow that was generated by the company sequentially, Q3 to Q4, free cash flow did drop quite a bit. And I have had projected their cash flow quite accurately before I did this video. It was a little tiny bit lower, but you don't want this to become a trend where, hey, cash flow is going to struggle because that would really lower the value of the company. Looking at the fundamentals of HIMS, they're a $10 billion market cap company and the revenue is 1.5 billion. That's not too bad of a ratio. Doesn't look too expensive when we look at the revenue to market cap ratio. When we look at the forward PE, that does look a bit expensive. 73 is a pretty high PE. Now they're a growing business, so if they can sustain that growth, they will grow into that PE. Analysts believe that the stock is a little expensive, and that's because the stock's really been going up over the past year. It went up 235% in its entirety, but it has really come down more recently. It really had a strong pullback. I think a lot of investors got out because really over the last couple of months, this stock has really risen in value. When we look at the growth of the company, revenue growth looks excellent. You got 69% growth year over year. Now, the reality is, as you get bigger, it gets a little harder to grow by these high percentages. So we'll see if they can sustain that high growth. Their free cash flow really expanded. They've started to become a free cash flow producing company, which is impressive. Now, can they sustain that? That's important. One factor that's coming into the picture is the whole weight loss category. Will the change in the FDA's guidance that they cannot mix compounds that basically take away revenue from Eli Lilly and they're able to sell it on the HIMS website? I think that's going to have an impact on the company. I don't know how much, but that might have an impact on free cash flow as well, as the company has to market to keep their revenue growing. Their gross margins are very good. There was a decline in gross margins. I don't know that it's a trend just yet that I'd be overly worried about, but we'll see. Their profitability, you see that they're going from gross margins of 79% down to 8.5. I think a big part of that is they have to spend a lot on marketing. And that marketing, I would say, back to, are they a healthcare company or are they a consumer company? That high marketing cost makes me believe these guys are more of a consumer discretionary company because you have to market to get new customers. You have to market to keep your current customers buying, being excited about a product, being reminded that they need that product, as opposed to some healthcare companies. Somebody has a drug that is taking care of an illness they have or a condition they have. The pharmaceutical company doesn't have to remind them a whole lot that they need to take that drug, or they may have symptoms that they don't like, or they may worse, die or something. So the marketing cost really shows up when you look at gross margin compared to profit margin for HIMS, and the free cash flow margin as well. When you look at, if they can establish higher free cash flow margins, then that'd be awesome for the company. I think their stock price would really go up. That'll be important to track as you look at HIMS going forward. 12 analysts cover HIMS on stockanalysis.com, and it's a good mix of bulls and bears. Some bulls believe the stock can go up to $68 a share, and the bears think, well, it could really drop to $21 a share, which would be a really big loss. Now, if we look at the mix, it's just slightly a buy, and it's priced a little too expensive by 14%. And that's after the company had a very strong pullback. When I look at the collective forecast on sales and then profitability, I see something that's interesting. When we're going from the year that just closed, fiscal year 2024, going into fiscal year 2025, revenue is going to expand about 42%. And that's really good. But profits are not. Profits are going to be flat. They're actually expected to decline a tiny bit. And that PE is looking really expensive. The other concern that I have is you see this growth rate. Now, when you're growing at these rates, you really catch the attention of Wall Street. But in roughly a year's time, in fiscal year 2026, which is 12 months from now, their growth is really going to slow down. And if they start growing at 15% versus 69%, what will the enthusiasm be for the stock? That would be interesting. I think the big sell-off we saw may be that investors are looking forward and saying, well, I don't want to be around when the company's only growing at 15%. That could be. I know that it would be a concern if I was sitting on the stock, I had a big gain, and I am looking at a forecast where their revenue is going to slow from 69% that they grew in 2024 down to 15% in 2026. I like to take all the data that I get for a company and try to value the company based on terms that make a lot of sense to me, and frankly have been documented from some of the best investors over time. And the true and tried method is discounting free cash flows. That's what Benjamin Graham said 100 years ago. That's what Warren Buffett's done for, 80 years or so. And Charlie Munger, his partner, free cash flow guy, as well as many investors depend on free cash flows. And it's really meant to kind of describe or put a number on a company. This is what the cash flows are worth. Now, a company could be priced higher or lower for other reasons. Maybe a company has a lot of momentum and those cash flows are going to improve in the future. That's great. But at least we could say at this day and time, based on the best forecasting that an investor can put out there, this is the number. So let's get into the numbers. And this is the best forecast that I can put out there for HIMS based on the information I've gathered, based on what I think the company is going to do. And first, HIMS has a very good cash flow number, and I'm going to grow that cash flow by 15%. And judging from the last quarter to quarter sequentially, you saw that cash flow did dip. As businesses get bigger, it gets harder to grow your cash flow. And what HIMS is showing is that they're not a big scale business. It's not like they built the capacity and they just need to sell as much as they can. They have a high marketing cost involved in their business. So it's not a scale business where they're just going to get more cash flow over time. I think they'll continue to have to spend that marketing. So the cash flow is going to be a little bit limited. Having said that, I still give them a fairly positive, optimistic forecast on cash flow, starting with the current year that they just closed, and I'm growing it by 15% in year one. And then the first 4 years, I'm growing by 15%. And then all years after year four, I'm going to grow at 4%, which is what you would think of for a healthcare company. Now, this is a smaller company, so I'm going to go with a discount rate of 9%. That discount rate will take all those cash flows that I expect in the future and discount them to today's value, which is 5.5 billion. They have good cash on the balance sheet, 300 million, no debt. So they have an equity value of 5.8 billion. Their market cap has risen to $10 billion, which is quite high. And you've really seen that increase in the market cap happen really over the last couple of months, which is a little bit hard to believe, right? Anybody who looks at a chart like that would probably agree that it's really hard to sustain that type of trajectory to see a chart really expand like that. Nonetheless, we'll just keep going with the numbers. Shares outstanding are 222. While I'm talking about shares outstanding, the share count has been increasing. I think that HIMS attracts talented people by giving those talented people stock. And I think that's a good idea. It just makes the company, it makes the higher share count dilutes investors a tiny bit. Not a big problem, but just wanted to point that out. So the value per share that I have is $26.51 based on free cash flows. And then we've got the stock price currently is $45. So the stock is being priced at a premium of 41%. So the stock based on free cash flows, I'm estimating that it's worth $26.51 to me, but investors are bidding up the price of the stock and it's at $41, 41% premium. Again, the recent surge in the stock price is a really hard number to believe in because it just may be that investors were really excited about the company. I can understand why. High growth business and they market really well. So maybe a lot of the HIMS customers themselves are buying the stock. But the numbers, this is where the numbers land for me. Earnings per share, as mentioned, the earnings per share is not expanding from 2024 to 2025. So that was a little bit of a surprise as well. Maybe that's also leading to the big sell off. I'm going to give them a generous 36 PE. I'm not going with the really high PE that they have based on their stock price. And I'm growing that earnings per share by 25%, which is a generous growth rate. Even when I go with those factors, I get a stock value based on earnings per share of $23.40. But the stock is trading at 45. So there's actually a 48% premium on the stock when I look at it through the lens of earnings per share. When I blend the two and I put more weight on the cash flow method, it's a 44% premium on the stock. So in my mind, I think the company for me is worth $25 a share, but it's selling at 45. So HIMS has really accomplished a lot in very short time, and their growth rate has been impressive. The bulls believe that the company is going to continue to grow. And if they do, my hat's off to them. I think they're going to continue to expand the value of the company and probably expand the products that they have. Now, the bulls also believe that profits will be maintained and free cash flow will expand. It has to in order for the stock to really be worth a lot more. The bears, on the other hand, they view it where HIMS doesn't have strong competitive advantages, barriers, moats, meaning they don't have a patent on their categories. It's not like they could say, hey, our hair loss treatment is proven to work. And we have this patent that we worked on and it keeps competitors away. They don't have things like that. So instead, they spend a lot of money on marketing, which is a lot like a consumer discretionary business where those companies have to compete in the marketplace to attract customers and keep customers. So that's one reality that could exist. Big pharma is going to be a huge competitor. If HIMS continues to get bigger, especially around weight loss, big pharma is going to pay attention and compete against HIMS and potentially litigate against HIMS. If HIMS goes a little too far, maybe competing against Eli Lilly, maybe Eli Lilly has a bone to pick with HIMS and begins legal proceedings to try to keep them from infringing on patents. Could be. And then marketing costs just too high for the company. And at the end of the day, if you have to spend a lot of your revenue just marketing your product, it's not a product that's worth having to consumers or a necessity for consumers. The best products are those where the company that makes it doesn't have to do much. Customers are just demanding it. More customers are demanding it. And that company doesn't have to do much marketing. So for those reasons, I am a seller of HIMS stock. I think the stock is priced too high. I think it's great that they're growing. I think it's great that they're doing what they're doing. But HIMS does remind me of a lot of companies that have come and gone. Are they the first company to say, "Hey, we can achieve weight loss for you, and you don't have to go to the doctor. You don't have to go, through these complicated hoops that the medical profession would put you in." No, that's been around for 50 years. From the 60s, 70s, 80s, there's been weight loss companies that have been there, done that. Okay. It's going to continue to be. We're going to have weight loss companies for the next 50 years. So it's not a revolutionary new thing. And in other categories like hair loss, that's been around forever as well. So these are categories that have lots of competition, too much competition. I'd rather have companies that have very little competition because the company that is in the leadership position has been so darn good. An example of that would be like Meta. You look at Facebook, Instagram, WhatsApp, they get over 4 billion people to log on to those platforms. Meta doesn't really do a whole lot of marketing. People just want to be a part of Facebook so they can stay connected to their communities that they want to be connected to, or they want to go on WhatsApp because it's become such a important part of communication for people, whether it be business or personal. So that really shows that Meta is just a dominant player, making lots of money, growing their cash flows. And they don't have to do a whole lot of marketing. So that's an example there. Of course, Eli Lilly, I rarely see a advertisement for Eli Lilly. And that's because their drug works. And doctors are telling patients, if you're a diabetic and you have these types of symptoms and conditions, the Eli Lilly drug may help you. And they prescribe it. And people tend to follow what their doctor recommends they do. I certainly do. So that's my video on HIMS. Interesting company, and had a really tough couple weeks. And in this market of 2025, we've seen really strong pullbacks. We saw the beginning of the year be quite optimistic, and then the month of February was kind of a correcting month. We'll see where the market goes from here. And I'll really be interested in seeing how the HIM stock trades. Thank you for watching. I appreciate it. Please like my video and subscribe to my channel if you like videos like these, and provide suggestions and comments on the video, please. Thank you for watching, and good luck investing.